Good morning, everybody. It's actually afternoon. Christian Thwaites, Brad Janikowski. Welcome to our market update webinar here on November the 10th, a week after the elections. So I know some of you are probably exhausted with everything that we've been through in the last week. So hopefully I'll be able to shed some light on what it means for some of the capital markets and your investments. As always, I'll have probably too many slides and I'll try to kind of move them and not get stuck on anyone for too long. But if you have any questions, there's a chat box at the bottom and we'll be monitoring it and I'll be able to see those and happy to answer questions along the way or at the end. And Carolyn O'Neill is kind of moderating things, so she's in the background, and hopefully she'll keep me from straying way too much off the brief. So yeah, well, we got through the election and as things stand this morning, obviously, the market perception broadly is that the election is settled, although, who knows, there might be some more legal conflagrations to come. But obviously not the clean sweep the market thought it was a couple of weeks ago. So that I think has tempered some of the enthusiasm about a big stimulus package. But generally, I think the market is okay with this outcome. Having said that, if we do get a kind of a long, protracted legal battle, then expect a kind of replay of what we saw in 2000, where we had to wait, I think, until December the 13th or something until that final Supreme Court decision came down. During which time the market went down 5%. But at the moment, we're in pretty good territory. So let me just start off by saying, kind of, this is where we are in November. Labor market has been incredibly slow to recover. The non-farm payrolls number, which you saw on Friday, I'll talk about in a minute, but they weren't quite as good as people are claiming. And what we're seeing is a bit of a replay of what we saw in 2008, with more people exiting the labor market where they're not counted, as opposed to being gainfully reemployed after being unemployed. Everything, I think, depends on the virus we're managing for now. Clearly, yesterday was a very big day with the expectation that this Pfizer test, I think this is the differentiating factor there was that the FDA made a decision on a Sunday, and they said that the number of test participants had moved from 32 to 64, and the indications look pretty good. There are still a couple of other pharmaceutical companies with tests in similar stages. So I think yesterday's news was different from what we'd been seeing the last few months, which was somebody had a test and they were testing it and it looked okay. It seemed a little bit more robust and a little bit more grounded. So I think that was genuine cause for optimism. The Fed is really the one where we talked about this before. It's expanded its role. Some would say its mandate, but its mandate is still low inflation, full employment, and a kind of a tertiary one of maintaining good order in the capital and bond markets, which they've clearly been doing extremely well. They did slightly change their some of their targets in August, which we talked about last time. But the Fed is sort of there, ready to help and push monetary stimulus as far as is possible. Congress, we expected the expired benefits. That was the $600 additional unemployment benefit, which expired at the end of July, and the various PPP loans, which expired about the same time, to hurt the economy a little bit more than it has. And so I would say that the recovery has been pretty good, in spite of those really not being replaced. Now we've got a couple more programs, which the pandemic unemployment benefits, PUA, and another one, which is a similar kind of extension program of unemployment benefits, which expired December 31st. So those are, we're still on the cliff edge with those, but a lot of the economy has done remarkably well, despite being having the expiry at the end of July. I hope you can see my screen okay. We do expect a stimulus, but the effects, even if it goes into action today, which is clearly not going to, but we're really looking at a low of 500 billion, which is what Mitch McConnell said that they would be contemplating, would think about, and the 2-point-something trillion coming from the Democrats in the House, and then the White House, who knows where they were, somewhere in the middle when they were paying attention to it. But I think the number is going to be bigger than 500, less than 2 trillion. But I think the important thing is not just what it's going to look like, but whenever it comes, even if it comes in the lame duck session, which is unlikely, it's not going to start hitting the economy till February of 2022. But when it does, it'll be big. We've seen the recent improvements in the economy. They're real, but they're slow. You know, housing is doing well, autos are doing well. We expect housing to roll over a little bit, just because I think, you know, demand has got a little ahead of supply. Retail sales have been fairly robust, although it's kind of shifted, of course, the patterns of retail sales from you know, store to online, and a lot of other shifts like you know, food at home versus food away from home. But generally, retail sales have held up pretty well. We've seen some tick up in capital expenditure, manufacturing. There was some decent ISM numbers last Monday, which were indication of a better trend. Trade is a bit of a mess, just because the way the U.S. economy is recovering right now is we're sucking in imports. You know, what the U.S. exports well, big manufacturing equipment, aircraft, that kind of stuff, are all sort of still in the doldrums, and we have a surplus in services generally. But the kind of things that we're buying right now as an economy tend to be a lot of electronic goods and consumer goods, and those have long since not been manufactured to any great extent in the United States. So we've seen the trade deficit tick up, which we kind of expected it to, and obviously all of the agreements that were put in place at the beginning of the year are basically you know, null and void at this point. You know, China is simply not able to buy the level of agricultural products which it said it would, and I think just generally, you know, U.S. export markets are still fairly weak. So trade will be a net drag, but it won't really matter that much, because we're, you know, especially in the third quarter, the GDP number was so big that the trade drag wasn't that significant. Obviously, we're going through a period of deficit spending. I mean, the deficit has increased. You know, the outstanding deficit, the percentage of GDP. I don't think it's a source of worry. You know, someone I know made a good analogy. It's like right now we have an issue where we've got to put out the house which is on fire. We shouldn't be worrying about the water damage quite yet. That comes later. And the U.S. economy is, you know, needs a lot of help in order to you know, get out of the recession it's been in, and that's going to be the source of deficit spending. But as a source of you know, worry in the future and crowding out the markets and in inflationary, and you know, it's, you know, every child owns 70, 90, 150,000, whatever the scary number is that gets put out, there is not a source of worry to the capital markets, I think, or to the economy. I think it's going to take a long time for GDP output to get back to anything like the level it was. I put 2021, even that's a bit optimistic. What we saw in the GFC was, you know, a trend line that just took a big dump down, and then it kind of went off at the same angle, but it was permanently below what the trend line had been. And now I've just seen another one. So I think it's going to take a long time to, you know, cross over, and we'll just be operating at a lower capacity than we were for quite some time. The unemployment number, the real one to look at, is this U6, which is the underemployment number. I don't think it's about 12% right now. I'd be surprised if it gets much below 10%. It really is a question of, you know, what kind of jobs come back, and then how many people take themselves out of the labor market. I think risk assets will probably do well post-election. Obviously, they've done very well the last day or two. You know, yesterday was a strong day. Last week was, you know, I think 5 or 6 successive strong days. First time that's happened, or only 12 times happened in the last 30, 40 years. So we've seen definitely a kind of a relief rally, and I think risk assets will continue to do well. There's still a lot of parts of the market which haven't been as strong as a kind of a narrow, more concentrated part of the market over the last 6 months. I think they'll do quite well. Post-election concerns, I mean, I'm a little bit of a guess. You know, we don't know. I mean, Mike Pompeo is something weird this morning, which would suggest that they're going to cause a problem, but I don't know. I'm not a constitutional lawyer, mercifully, because that would be a very bad one. But I think I think most of these will peter themselves out over the next few weeks and months. We'll see, but it's probably not going to be the smoothest and friendliest transition we've ever seen. I would sort of kind of throw this up just as a source of, look, we've had big corrections before. With the 2021 down here at 33% was pretty big. 6 months later, we're up 52%. This is kind of what tends to happen when you have a big drawdown. You get a pretty good return. 2000 and 2002 was less of one, just because we were dealing with a almighty financial overhang from the tech bubble. 2000, 2007 and 9 was actually, took a while to get back. We had it in a year and 3 years later where we took a while to get back from that peak. But so far we've done very well on this one. And I'd say this tends to be the pattern where we get some good returns, definitely 3 and 5 years later. I kind of put this up a bit of facetiously, but and I put it in the blog last week, but really it's very difficult to see any material pattern of stock market returns depending on who's in the White House, what party's in the White House. Presidents claim all sorts of success for the economy and for the stock market, some more than others, but I think generally the market and the stock go along, bowing to bigger forces than just what's in the White House. I mean, and really where you do see bad stock market returns in an administration like Bush, you have to say, well, look, there was just a heck of a lot going on there, not just the recovery from the tech crisis, but the beginnings of the great financial crisis, which weren't, neither of which were really a result of administration policies. So I'm not a big fan of looking for patterns in these. You can have another one here which says, well, here we go, here's the returns under Obama, 53 and 84, and then Bush we had 2 negative years. But if you try to draw a pattern here between who they were and what their policies were, you'll had a tough time. And it's the same with, if you kind of go on the same numbers and say, well, let's look at a split Congress with a Republican president, look at a split Congress with a Democratic president, let's look at a unified government of the Republicans. I suppose you could say, well, just fortuitously a split Congress with a Democratic president is 14%, but if you take out Obama and Clinton, the numbers shift down quite a bit. And then a united government, all Republicans seems to be pretty good, but then a lot of that's Reagan. So you'll see a lot of these charts, and the other thing I'd cut to remind myself is that we're only talking about returns since 1945, and there aren't a lot of data points. You've had whatever it is, 20 presidents since then, something like that. But anyway, you're not talking a lot of different data points, which would say, well, here's a robust model, and if you get this type of government in place, you'll get this kind of return. So I tend to kind of view all these as with a bit of a grain of salt, and I think it's much more important what the broader economic policies and conditions are in place. But we do have to contend with the fact that this is what we're living with in the COVID world. And, you've probably seen this as a log scale. So United States, very much in that second wave. Here's the first one, here's the second one, and here's the third one. Inching up. Europe, which was seen to be doing so well, is now just on an uptick there, and maybe that's weather related, and maybe that's just some shift in changes from one part of the European Union to another. But clearly, no one's really got the handle on being able to contain this. Some Asian economies have very well. Taiwan and South Korea are outstanding standouts, but certainly where we're talking about the economic powerhouses, this is really what we're dealing with, which is another set of pretty big cases. Let's have a look. Here we go. I missed over one. Okay. I talked about this the other day in the blog, and this is what I'm more concerned about. It's not so much shutdowns and rolling shutdowns. I think we're going to see plenty of those. Some will be more extreme than others. Some will be by town, by state, by locale, by county, similar to what we're seeing around here. But I think generally, whatever the government mandates are, there'll still be a reluctance to conjoin and accumulate and crowd together in events. Now, this could be sporting events, outside events, colleges, restaurants, all these kind of things, which people are going to say, well, hang on, regardless of what the actual legislative requirement is around here, I don't want to do that and expose myself and my family. And I think, people are naturally and should be scared of spreader events. So yeah, if you pick a map of the United States and roughly put your finger right in the middle of it, you'll find Sturgis, and that's it is. There it is right there in South Dakota. It's a population of 6,000. But every year it has a motorcycle rally, which attracts about 500,000 people. And obviously 500,000 people can't fit into a town of 6,000 without being in extremely close proximity. There were no masks, there were no regulations, there were no social distancing. There were, other than a few signs outside of town saying, be careful. People came from 61% of the United States counties. And if you kind of look where, what the contiguous states were, and then what happened next was, well, no surprise, you saw a huge spike in cases. This has been pretty well documented, although some people still dispute the findings of the various different studies on it. But to me, it's not a question of whether Sturgis was right to be held, probably wasn't, but it's certainly caused a huge spike in cases all around them. And places like Wisconsin are really suffering quite badly. It's got a much bigger population, of course, neither of these two states. But I think the point that I take away from this is, look, people just are not going to be comfortable, being together and crowding around each other. I might do this right. Here we go. I have to rather, if it looks like I'm unsure changing the slides, because I am. So the Federal Reserve, we kind of mentioned as being the major game in town. You can see that right out of the gate in the crisis, they bought everything they could. And they were really sort of being a backstop to all of the bond, treasury markets, mortgage-backed security markets. What they didn't want was to have a kind of liquidity crisis on their hands at the same time as a potential financial crisis. So they moved in very, very sharply, basically using the same tools as they did back in 09 and 10, except very much putting them in the fast lane. So this is the Fed balance sheet, excludes some parts of it. It just included the mortgage-backed securities and the treasuries, so $6.5 trillion. And you can see it's just been edging up. The Fed is on a program of about $120 billion a month, 80 in treasuries, 40 in mortgage-backed. You can see the rate of change has begun to diminish. On the weekly basis, it was growing at some astronomical rate, 500%. Now it's sort of down at about 21% on an annual basis. I don't think they're going to continue at that rate. It'll stay high and probably edge a little higher. You'll see this kind of slope kind of level off. But the point about it is the Fed is ensuring that the rates stay low pretty much across the curve. So that's why we're really not expecting much to happen in the way of rate changes, all the way from short-term money market rates, 3-month bills, all the way out to certainly the 10-year. The 20 and 30-year might move up a little bit more just because the supply-demand equation is out of balance a little bit out there. But we're not expecting any uptick in rates and therefore bond concerns. I think I mentioned this last time, but it's well worth reiterating again. When the Fed came out at the end of August in the remote version of the St. Louis Fed's annual sort of get together at Jackson Hole, they basically said, look, we're not going to think about changing rates until we see unemployment at 4.1% and inflation at 2%. I'm not quite sure why they choose 4.1. I think it was just because it was an average of the different outlooks forecast by the Fed committee members. But you can see that if you kind of take it at face value, and I don't think we should be, taking the Fed at any other value right now, that doesn't happen very often, where you've got 4% unemployment. Here's the blue line hitting this CPI number at 2%, and we'll get a CPI number Thursday, and I don't expect it to move very much here. It might move up on a core basis, but this is broad CPI, and it's very difficult to see that move very much. So again, it's just really saying this doesn't happen very often. It's happened 4 times since 1952. So the Fed is giving itself a lot of leeway to keep rates low. We've seen some uptick in rates recently. You can kind of see it over here. 1.75 on the 30-year. The 10-year last time we talked was about 70 basis points. Now it's 95. I read some of that as to being a reflation trade, that people think that there's going to be a little bit more growth, which is good. Maybe a little bit more inflation between very, very small changes here, and maybe some upward pressure on rates. But I think, again, the Fed will probably come in buying the 10-year if they have to. They're not right now. It doesn't seem in very big sizes in order to kind of keep that from getting too out of hand. You can see at the bottom there that 2-year bond market, 2-year bills are really just flatline, and they're going to price much closer to the federal funds rate. Federal funds rate is 0 effectively. So this is 18 basis points, and that's been flat, and we expect that to pretty much stay there. We should probably mention the deficit just because it gets a lot of airtime, and I'll be frank, Republicans are very kind of financially conservative when it suits them, and a bit more profligate when it doesn't, or the other way around. But right now they're going to start talking about the deficit again. I don't know why it's coming on to me. Let me turn that off. I really don't think this is an issue. It looks like the deficit this year will come out about 16%, which sounds pretty scary. Yes, it is. It's twice what we were in the global financial crisis. But as I said, we can afford it. The economy really needs to get going, so that's important that we kind of not lose sight of that. Sorry, my phone is going crackers here. Next year, these are the estimates for a much lower number. It's going to take some time before we kind of get back to these levels. Notice that the deficit was already creeping up, even though the economy was in pretty good shape. And this is all due, 18 and 19 was all due to the tax cuts by the 2018, effective 2018 tax cuts. That was the cut in corporation tax. And some of the other personal tax cuts came through. So we were already heading down in that direction. And obviously now with revenues being way down, tax collection revenues being way down, we're heading into a higher deficit. But as I said, I don't think this is a source of worry right now. Another reason is that the Treasury has been amassing an awful lot of money in their daily account. This is the daily Treasury account. This is where the Treasury pays its bills. So, pays Social Security out of here, pays the military, pays all its bills on a daily basis. And you can see that number literally printed every day. And normally they're at about 400 billion. You kind of put this number back and it's pretty low. They've been amassing a huge amount of money into the daily Treasury account. Some of this is because they're getting money back from the Fed for the QE buying. But also a lot of it is because the CARES Act had a huge stimulus. A lot of it hasn't been used, which sounds crazy, I know. But the PPP loans, yes, they went away. But a lot of the supplemental insurance, but it was a pretty big package, and a lot of the numbers which ended up in the various different departments of the government just haven't been spent. So, I see this as a good sign that the Treasury won't be sort of running out of money any soon, or having to make panicked Treasury debt sales, so which would affect the bond market. So there's still a lot of firepower that the Treasury has before they have to worry about borrowing more. This is basically just the yield curve inversion. The lower the number is usually kind of pre-recessionary. It's the difference between 10-year rates and the federal fund rate. It's crept up a little bit, which is a good sign. Down here, it kind of means that the economy is really having a tough time. So we've seen a little bit of an increase recently. That's generally a sign that maybe the economy is sort of moving in a slightly better direction, because it basically means that long-term rates are edging up a little bit, but it's still very much in the controllable space. Yeah, my big concern is watching the labor market. It has come back, but it has come back very, very slowly. I mean, we saw this huge spike in claims right out of the gate. These unbelievably high numbers. Remember, before this, the record weekly claim was 630,000. That happened in about for 1 month in 2009, and it happened once back in 81, which was actually worse because the labor market was quite a bit smaller than then. And so we've come down from 6.5 million, mercifully, where these numbers were just really shocking with people just being laid off left, right, and center. And then this is a log graph, so I apologize for that. Otherwise, it would look very weird. But you'll kind of see that, the improvement has, I think, a fair point would be, has been, the rate of improvement has been slowing. And so we've been stuck at around the 750 line for a while. Now, there's some weird things going on in claims right now, because it used to be a simple, I go to my local unemployment office, I file for a claim, and it's approved, a week or two later. With these other different programs, there are people switching from different types of programs and into programs. And if they might have also been some double counting of people who went back to work at the end of the second wave, and then got laid off again as we go into the third wave. So, but anyway, the point is that the claims numbers should be heading lower, and they're still not. And there's still 25 million people on some sort of benefit. So it's a very slow market. This is the numbers that came out on Friday, where a couple of the commentators were talking about this great job growth. Well, again, round about here, we lost 22 million jobs. If you add all these together, you've had 700,000, a couple of round about 500,000 or 600,000. You've only made back about 10 million of these. I think next months are going to be even below this number, and part of that is because we're seeing the end of all the census hiring. The census hires people to do the census, and the number goes from some very small number of people who run it in the census to 60,000, 80,000, and at the peak there's about 220,000 people working for the Census Bureau. Now that the census is all finished and those numbers are reversing off, for some bizarre reason these end up not being classified as temporary jobs, but as permanent jobs in the government. So we know that this census hiring has been, is coming off the gas a little bit. And there's other indications that the labor market might be, weak for the next month or so. This is this 12.1% unemployment. I kind of ignore this one because this is the one where people, misclassify themselves. And this is the one which I think is more accurately talks about the slack in the labor market. Basically, you won't get any inflation while this number is up at these levels. Even down here, when it was 5 and 6%, we were having a hard time with inflation. So you're certainly not going to get any kind of wage push inflation with 12% of the labor force being underemployed. This is always a nervous one. This is basically where job loss is going from temporary to permanent. And as I've said before, this is really about an office closes down, a plant closes down, a business closes down, and the people are not going to be able to come back. The workforce is gone, or that position is gone. And there's been some flurry of layoffs announced by S&P 500 companies. Some of them obviously temporary, like the hotels and the theme parks and the airlines. Some of them are going to be more permanent, and we've seen some of those mid-office type of jobs be announced as part of a permanent layoff scheme. But this is, again, you've got to watch, because it accelerated very high, and it took us a long time to get back to normalcy. In fact, I sort of even contend that we never really did get back to normalcy. So in prior recessions, this number is kind of take it way back, it kind of pops up and then it recovers. But we've had this big spike, and now we're in the middle of another one. So we've got to look at that one, make sure that one doesn't go too high. This is the economy. This is the kind of printed headline GDP number that I mentioned before. It's the way we talk about GDP in the US is kind of makes sense, except it doesn't make sense when you get numbers like this. Because what we look at is we look at the annualized numbers of the annualized GDP numbers. So we measure all of the GDP measured in a quarter and multiply it by 4. And then we say, how much did that change from the prior quarter on an annual basis? So if I haven't tied your heads too much around in knots in that, it basically makes the numbers look pretty good, but it also tends to exaggerate small changes. But kind of to keep with this kind of nomenclature, we had a 5% decline in GDP annualized in the first quarter, roughly equal to about 1.5% year over year. This big 31% decline in the second quarter, and then this big headline grabbing 33. But as all know from asymmetric returns in the investment market, you have a 31% decline, you need a heck of a lot more to get back to base level than the 33% gain. So this is kind of, it's heading in the right direction. This is the 4.6 cents estimate that's coming in for the fourth quarter, although it might end up being a little bit lower than that. This is really what's going on. This kind of takes what the US GDP is in dollar numbers and printed over a per capita basis. And there you can see that, yeah, we were down on a year-on-year basis, measured with GDP per capita divided by the number of people in the country, was down, very nearly 10%. In the second quarter, it was down 3%. It's going to be down again. So these numbers, you go way back, and there's nothing like them. So, big hole that we're digging ourselves out of. This is also a little bit encouraging. Now, I wasn't able to say that a month ago because the participation rate, people taking themselves out of the labor market, was running very high. It's ticked up a little bit in all classifications. So here we put people in the 25 to 34 group. Took them. So these aren't the unemployed. These are people who just said, "I'm not going to be working anymore." Probably because they couldn't find anything. So they classified themselves as not looking for work, and that came down, but that's ticked up. That's going to be at the highest participation. And then the next one is this bottom one is at 80%. That's the 45 to 54, and this one is the retirees. This is essentially the 55 and over. Not all retirees, of course, but obviously this number was the only one that actually increased from the 2000 GFC base, and it's not fallen as much. And we kind of know that the average age of someone who tends a bar is about 30 years old. The shutdowns and everything affected a lot of service industries. Boom, it affected a lot of younger people and lower paid people. We kind of know that trend's been in place. But the good thing is here, what we've seen a little bit of an uptick is a little bit of a jump back in the last quarter, and we really want to make sure that people don't take themselves out of the labor market for too long a periods, because they become difficult to reemploy, or rather employers are reluctant to employ people who they feel their skills have atrophied. So we want to make sure that the participation stays up. I'll skip over that. It's pretty much the same story. This is interesting. This is all of the money that was given out in extra unemployment benefits essentially found its way into savings. A lot of it just wasn't spent. A lot of people might have felt that they had to save because felt a little precarious about the future, or they got the money in, they had nowhere to spend it. But the upshot of it is that we have an awful lot of excess savings in the system right now. This is, $1.1 trillion worth of savings. This is just sitting in bank accounts. There's other sources of savings as well, although those numbers are probably not as dramatic as this. Checking deposits, by the way, have a similar sort of line, but this is just the savings deposit. But yeah, there they are at 55% of GDP. I mean, they never usually get to anything like that. So this is good because it means that there's potentially a lot of spending power in the economy. If things come back and if people feel that there's more confidence, this is equivalent to about 3 or 4 months worth of retail sales. And it doesn't mean they're all going to go about buy retail stuff, because they've got got other things like housing and transport and stuff to buy as well. But it does tell you that the savings rate has climbed and it's stayed pretty high, and there's potentially an awful lot of spending that could come back into the market at very short notice, and that is unequivocally a good thing. One of the major things about this recession is that people are not highly indebted. This has not been caused by people having very high mortgages and not being able to pay them, and very bad mortgage to loan ratios. So they kind of throw the keys away because what they owe is worth more than the value of the house. This is not because people have run up massive credit card and other consumer loans, auto loans, other types of revolving credit, and are now in trouble, including student loans. This is all about the supply side being taken away. So the consumer is actually in relatively good shape financially. They're not sort of heavily indebted and worried about their borrowings. And this kind of shows how much they've been able to amass in the last month or two, 3 months. This is kind of try a snapshot of what's going on in the small business market. This is Homebase. I borrowed this slide from one of our vendors, but this is, I don't know if you've heard of Homebase. I hadn't. It's a relatively new company, but they basically do the payroll and hours clocked and for small businesses. And you're talking, very small businesses. It might be landscape, might be, laundries, it might be, bars, hotels, all that kind of stuff. But and it's not seasonally adjusted, which is why this number looks so aggressively up and down. But if you kind of take the 7-day moving average, we were down about at the peak about 22%. Then it got slightly better. We were down 20% from January, and it's kind of slipped off again. And I think this is all to do with what's going on primarily in the Midwest and the various different, closings that we've had. But it's not a great indicator, which is why we see that in the sense that if this persists, then you're not going to see a big improvement in payrolls or indeed sort of economic activity over the next month or two. This is, I think, a reflection of people saying, we tried, but we're not able to stay open as much as we were, as we had hoped. These are some other indications. They all tell the same story, which is that over here on hotel occupancy, it's flatlined. Here it is on open table data. It's essentially flatlined in these different metropolitan areas. And here it is on commercial flights as a percentage of what it was in 2019. That's the top line. And here we are kind of floating at this bottom line here, pretty flat. So yeah, we've had the recovery. It's, as we mentioned, it's not V-shaped. I don't know what shape it is, but it's kind of like a U within a flat, then out of the trough, but sort of at a lower level than we were. And all these numbers sort of point to roughly the same sort of outcome. We've talked about that. This is just the consumers not wanting to take on a lot of debt, which is good. Consumer confidence is off its lows. So this is the broad blue line, blue bars are the, obviously the virus hit and people's confidence took an almighty hit. But at least they come off the bottom here. The younger people took a bigger hit. They were more confident going in and they're less confident right now. And that again, very much makes sense with the types of businesses and the level of employees that have got impacted the most by the COVID shutdowns and recession. The under 35s are in pretty bad shape. Over 55s, especially people who've got savings accounts and 401ks generally tend to feel a little bit better about their future. But this number has been, they've all had a little bit of an improvement, which is good. And we expect that to kind of continue to just improve marginally. Take a while before it gets back to this level, but it's slightly better than it was at the bottom. We've also talked about this. Normally in normal recession these days, but normally you'll see things like house purchases and car purchases take an almighty dive, but not so in this case. They took the dive, but now they've come back with a vengeance. And this is people who, again, the average, I mentioned this before, the average car buyer is 53 years old. The average house buyer is about 47, 48. It's not first time car buyers or first time house buyers, but they're quite a bit older than the average person who lost their job. So they've got some discretionary income. We know that because we saw all the savings there. And these are people who might have an extra person living at home. They need an extra set of wheels. Or they might have commuted by public transport before and now suddenly don't want to go there. And also, I think the level of the level of trucks to autos has come up again. I wouldn't read. It's difficult to read too much into that because the trucks doesn't mean everyone's buying a Ford 150 or a Dodge 1500. A truck, a Porsche Cayenne is considered a truck. Just because if it's got certain types of tinted windows and is on a truck chassis. All those BMWs, hatchbacks are basically are trucks. But basically, it's a trend towards bigger cars and bigger vehicles, either for space reasons or because they just seem to be better value. But anyway, you kind of put the two together and you can see that that's really, what's that? Call that a recession? Not very much. It's it's taken a big dip down where everything closed down, but it's come back pretty well. Same with houses. There are different ways of measuring houses, new home sales, existing home sales, pending, but they've come back very, very well. And even though it was a little bit of a dip last month, we've been building about 1.4 million houses and multifamily units a year for about the last, an annualized basis for the last few months, and about 950,000 of those are being sold. So that's quite an uptick. And obviously, it was a slow, comeback improvement from the depths of the GFC, and then starting this big spike. And again, I think that's a lot of people. There are people moving, out of the cities. I don't think it's quite as big as people think it is, but people moving to different size houses or trading up or realizing that they, might need more space than they thought they wanted to. And of course, mortgages are incredibly low. You can sort of get I don't know what, if I can get 3% 30-year mortgage, but pretty close to it. And in some parts of the country, particularly in the southeast, you can get a perfectly good house. The median price in the southeast for a new house is only about, I say only 300,000. It'll buy you a cupboard in the Bay Area, but nationally there's some very good sort of house bargains to be had, especially given at these rates of borrowing. So those have both been very important parts of the economy. So the S&P, well, we didn't quite make it to another record close, but we're very close to it. Essentially, we've been in a sideways market. I would call this a sideways market for the last couple of months. There's been some nasty sort of corrections and back up again, but it's kind of typical of what you see at times. Like I'm showing different places here where, there isn't a necessarily big uptick in breadth in change in the entire market, but you get some pockets of which are doing very well. I'm very encouraged to see this number, $59. That's dividends on the S&P. And remember that 180 or so companies out of the S&P 500 don't even pay dividends. So, this is a smaller base, and they have cut them, sure, from a level of about 62, 63. But that's pretty modest given how cash strapped companies were or feared they were going to be just a few months ago. Earnings are definitely off their peak, but again, this number is better than it was when we met a month ago. I think it was about 122 then, so it's about 123 now. Yeah, peak earnings we know were up here at about 145, but this is generally getting better. It's kind of like I remind myself that earnings and dividends. This is the dividend line, nice and straight. This is the earnings line. Bit some squiggles and ups and downs, but the price of stocks goes all over the place. But that's a lot of that's driven by nervousness and concerns which are really nothing to do about underlying earnings and so on. So yeah, we've had a very nice return from the depths of the market, and generally earnings have stabilized quite well. It's been a mega cap story. This is the top 5. This is the Apple, Microsoft, Facebook, Google, Amazon guys. So if you kind of went into them in the beginning of the year, you're up 48%, and the S&P you're up, as of yesterday, up S&P 100 up, which includes these guys, up about 11%, and the S&P 500 up about 9%. That's closed a little bit, just because the last day or two where other parts of the market have rallied a bit. But I really draw your attention to the bottom ones, which is that we're beginning to see small and mid cap come. I mean, they took a dive like everybody else, not as much as the top 5, not as much as the big caps, and they've slowly wound their way through. And this recent uptick has been, the last couple of days, we've seen this move from tech companies to small companies. We've also seen a little bit of a rotation from growth to value, and also market cap to equal cap weighted stocks. So things have certainly taken a change. Whether or not this is a big systematic secular change, I kind of doubt it, but certainly it's encouraging to see the small cap revival. This is the equal weight versus the capitalization weight. We use this one. Most people use this one. 132, up 32% since beginning of 2019. And this is another way to think about this is the median price of all of the S&P 500 stocks, not the average price of the capitalization weighted guys, because this is where 5 stocks make 25% of the market. This is where every single stock only represents 0.2%. So 0.2% times 500 gets you to 100. So this normally does a little bit better than the market cap weighted, but it hasn't. Certainly you can see the big discrepancy right here, but recently it's come along, which is good, because that means I think you're seeing more people saying it's maybe not just a tech story. Maybe there's something there for energy and financials. Maybe there's something there for industrials and materials and these other cyclicals to stock. So a little bit of a more broad-based market. Energy financials are just, this is what I've taken is financials and energy is blue line, and this is the tech, and it's the consumer, it's the communication services. So this is kind of, the tech energy bank, split apart, and it's come totally different directions, but again, that's come back a little bit recently. I mean, you kind of have to squint to see it, but down here, this number is, come up a lot better. Again, I don't know if that's going to, cross over and it's going to be an energy financials world like it was in the early 2000s. Again, I certainly wouldn't bet the farm on it, and but it's good to see that the market's become a little bit more broad-based recently. So I'll try and wrap this up, and then maybe we can take some questions. I think large caps are still going to be they're just going to be a little bit more robust. They're going to be able to withstand the shocks. They're going to have more exposure to the global upside, and tech still, to me, looks fairly good bets. I mean, some of them are more expensive than others, but they're growth businesses. I'd say that stay confident that the fiscal boost will happen. It'll be messy. There'll be a lot of squabbles. There'll be a lot of people who will start sort of reclaiming the fiscal probity ground again, but it's going to come, and it'll start hitting round about early 2021. So if we get the fiscal boost, more optimism about a vaccine, the Fed stays its hand. I have no reason to suggest that why they wouldn't. Then we get pretty strong growth coming in 2021. We just kind of got to get through that period before it starts to show up in the numbers. I think the short-term risk is, how bad is the third wave? We're kind of living through it, so we may be answering our own question. I don't think there's the big shutdown where everybody's, sitting at home and not doing anything. There's more kind of a managed shutdown. I think the way we're managing it is sort of on a state-by-state, local-by-local level. I don't think we talked about COVID fatigue, and I think people are in no mood for a complete shutdown again. But that certainly remains a risk of how deep that is, and how broad it is, and how long it lasts through the winter. I put the election legal challenges in here just because I don't know. This might be all bluff and bluster, and someone, an administration which is on its way out is just sort of throwing a lighted gasoline torch into the house as they go out the door. Or it could be something which gets a bit nastier, and we start having more legal cases, and it ends up in the Supreme Court. I don't know. But I think that the longer it kind of goes on at this level, the better. It starts sort of language starts getting a bit more feisty and more aggressive, then I think the market will do what it did in 2000, which is get a little bit nervous about that. But tech regulation, there's no doubt that the big guys, the 5 I mentioned, are in the regulators' sights right now. That report came out from the subcommittee, the House Judiciary Committee, subcommittee of the Judiciary Committee, talking about the big 5 in particular, and various different parts of the administration have already started to move against Google and Apple. I mean, they're in a discovery phase right now, so we'll kind of see what happens. And my lesson from past deregulatory exercises, whether it's recent ones like Microsoft relatively recently. Actually, there's a much bigger one that's been going on with chicken providers, because I think about 78% of the country's chickens are 3 guys. Tyson, Purdue, I can't remember the other one, but anyway, they were caught absolutely price fixing. I mean, it was absolutely there in memo trails and everything else. It took them 6 or 7 years to assign a fine against them. So my lesson from this, as a bystander, is it takes an awful long time to work its way through. And these guys are a lot better defended and have a lot more money to spend on defending themselves than the chicken industry. Long-term risks in a labor force recovery, I worry about that because of the permanent job losses, people staying in employment for 27 weeks or over. That's the demarcation considered long-term unemployment. A number of people are still on benefits. The attrition of skills. So all of these things are a concern that the labor market will take a while to recover. Will be operating at suboptimal capacity. And then if we essentially get what we had in the post GFC recovery, we never really got above 2% in recovery. I mean, it was a little occasional quarter, it was bigger than that, but essentially 2% was the number we had, from 2009 through till first quarter of this year. It doesn't matter really what you threw at it. We were in that type of slow recovery, and everything, we've seen, housing, employment, number of other different indexes just took a long time to recover, and hopefully this will be, a little bit faster, just because I think the fiscal stimulus will be bigger, and we've learned from the CARES Act that it's actually been quite successful. So I think applied in the right direction, there'll be more of a kind of a boost behind the recovery, which will be good for us. Rates are going to remain low for a very long time. The Fed and other central banks are really much on full ease mode. And as I said, the Fed really wants inflation at 2%, and they're going to take a while before they get there. Gosh, I feel like I've seeing my screen. Don't know why that's coming up. Maybe I'll stop sharing the screen to see all my work there. And if we have any questions, doesn't look like we have, but feel free to either call us or your financial advisor or whoever it is at the firm, and or you can just email them directly to me at cthwaites@bnjadvisors.com. And I think we're going to throw this up as the slides, if you want to have a look at them on a recorded line. So thank you very much for all that. Sorry to take up so much of your time, but I think we're in generally a good place. It might be a little bit rocky for a few more weeks. I am going to read the disclaimer. And here we go. Discussions of the investment strategy, research, investment process, Brown Jankowski, as of the date indicated, or as of the day of this presentation, subject to change without notice. Charts illustrated throughout this presentation may be updated periodically. We have no obligation to provide revised assessments in the event of changed circumstances. We cannot assure the type of investments mentioned in this presentation will produce the intended results or outperform any investments in the future. We reserve the right to change our investment perspective and outlook without notice as market conditions dictate and additional information becomes available. Diversification does not protect an investor from a market risk, does not ensure a profit. The information is subject to unintentional errors, omissions, and change without notice. All sources are from facts set unless otherwise noted. Where we gather this information from sources we believe to be reliable, cannot guarantee the accuracy or completeness of any statements or numerical data in this presentation. References to an individual security should not be construed as a recommendation to buy or sell that security. The securities noted in this presentation are several of successful and unsuccessful investments by Brown Jankowski do not represent all the securities we have purchased, sold, or recommended. Index returns include reinvested dividends and interest, but do not reflect commissions or transaction costs. Mutual fund returns include reinvested dividends, capital gains, distributions. Mutual funds are net of the fund's expenses. They do not reflect Brown Jankowski's fees. Please read the prospectus carefully before investing or sending money. Past performance no guarantee of future results. We may reference various hypothetical investment illustrations. These are for illustration purposes only, not investment recommendations. Do not guarantee indication of future results.